When I first got into the market, I opened up an E-Trade account and I literally had no idea what I was doing. I just knew that I wanted to make money, so I figured I'd start with the cheapest stock I could find, wait for the price to go up, and then sell. I figured since the price was at its lowest point ever, surely at some point it was bound to go up, but I think I held that stock for about a year and a half and it never went up. It just kept falling and falling until eventually I sold for a loss. The loss wasn't too bad because it was just a $100 investment, so no big deal. But during that time I held that stock, I kept educating myself so I can learn the best way to go about things. And the first few books that I read kind of guided me towards long-term investing. So that's what I started to focus on. So I started buying solid companies, and these companies are big, popular companies that you've probably heard of. I researched the companies, I analyzed the news releases, I read the financial reports, all because I wanted to make sure that the company was going to keep growing and making profits. Now, this was back in 2013, and I think everything was at all-time highs, but that didn't really bother me then. I bought the stocks anyway because, you know why? These companies were strong, and the fact that these companies were at all-time highs proved that they were strong. My plan was to hold these companies for many years, so it didn't really matter when I bought. But unlike the first stock I ever purchased, I didn't buy a bad company thinking I'm getting a good deal because the price was so cheap. I picked strong stocks with the financial statements to back it up. What I was doing here was basing my decisions off fundamental analysis. Now, fundamental analysis evaluates a company's management, its competitors, growth potential, income, its expenses, its debt, and a whole bunch of other factors. Pretty much anything that can shed light on the company's overall health. Now, the goal is to find which stocks are healthy enough to provide the highest rate of return over time. And the rate of return is going to come from a company's earnings. Earnings are profits, and increasing earnings means an appreciating stock price over time. But when earnings fall short or miss expectations, then that's when the stock price can start to lose appreciation. But in order to profit well from fundamental analysis, you need time for the company to grow. So this is something that you would do if you are investing long term. Now, long-term investing is different than trading. Trading, you are only in a position for a short time. So the fundamentals of a company doesn't really matter. When trading, what matters is timing the market right while managing your risk. And we do that through technical analysis. Technical analysis is where we try to determine future price direction through the analysis of historical price movement. And we do this by looking at charts. Charts are going to help us see the story of the stock. If a stock has been rising for some time, that's an indication that business is doing well. But if a stock has been falling on a chart for some time, that's a sign that the company is having problems. Charts can help us see patterns and trends that the stock price has made, and the philosophy behind technical analysis is that history tends to repeat itself. Why does history tend to repeat itself in the stock market? Because the stock market is fueled by human emotion, greed, and fear. And human emotions tend to be predictable, showing repeating patterns given the same circumstances. By analyzing what has happened in the past, we can determine possible buy and sell signals. Notice how this stock pinballs in between these two blue lines. And these lines are what we call support and resistance. And that's really the technical analysis, using lines, shapes, and indicators on our charts to help us see patterns. And this stock right here is showing a pattern of bouncing off the bottom line, rising to the top line. Once it rises to the top line, falls back down, bounces off the bottom, rises to the top, falls back down. So maybe in the future, we can maybe predict that the next time the price comes into one of these levels, it's going to bounce off the opposite direction. Now, at first glance, this may seem confusing on why technical analysis even works. How are drawing lines and shapes going to make choosing the right stock easier? Well, most people these days use technical analysis because it's much easier to learn and understand than using fundamental analysis. So what technical analysis has become is sort of this self-fulfilling prophecy that makes it likely to occur. If thousands of other traders have drawn the same lines that we have done here, and we are all concluding that this stock will pinball in between these two lines, if price falls to the bottom line, most people will buy. And if price goes to the top line, most people will sell. So really, technical analysis is just about finding obvious chart patterns and try to anticipate what the majority of people will do, and then we can try to profit from that particular move. Now, one thing I want to point out here, no matter which method you choose, it's impossible to predict the market with 100% certainty. There's just too many unknown factors that make it impossible to know to make a guaranteed prediction. No matter how well of a fundamental analysis you have done on a stock, and no matter how good it looks on paper, there is no guarantee that company will continue to thrive. Anything can happen. The CEO could get caught doing something illegal, the company gets sued, and then things start going downhill from there. That's something that's possible to happen and something impossible to foresee. So if we can't predict the future, why do people even bother with the market? It all comes down to probabilities. The chances of a CEO getting caught doing something illegal that brings down the entire company is going to be slim. It could happen, but it's a small chance. The chances of a stock bouncing off a support and resistance is high, but there's a chance that it doesn't. So the goal is to find the highest probable opportunity and manage your risk in case that opportunity doesn't work out. It's important to understand that there will always be risk involved. So knowing that, you need to make sure that you have a risk management plan, which we'll talk about in a later lesson. So which method works best and makes the most money? Well, that depends who you ask. They both have arguments to why one is better than the other, but you have to realize that it's like comparing apples to oranges. Fundamental analysis is aimed for account growth over a long time period. Technical analysis is primarily used for quick profits to produce income, but no one says that you can't use a little bit of both in your strategy. If you find a fundamentally strong stock that you want to hold for a few years, you can pull up a stock chart and try to figure out a good buy point through technical analysis. If you want to make a short-term trade using technical analysis but want to be a little bit more conservative by choosing a fundamental strong stock, that's okay too. There's no one best way to do things. All that matters is that you have a solid strategy, you stick to your plan, and you manage your risk. If you can do all that, then you'll make money no matter which route you choose. So let's say that you have picked out the method you would like to implement, and out of the thousands of stocks to choose from, how do you even go about finding the high probable opportunities? Well, this is where stock screeners come in. A stock screener will allow you to input specific criteria that you want the stock to have, and then it will scan the entire market and only show you the stocks hitting that criteria that you specified. For example, if you only want to see stocks listed on the NASDAQ, and you only want to see large cap stocks, and you only want those stocks to be in the healthcare sector, whenever you click search, it's going to pull up only stocks hitting all three of those criterias. And you can get really granular with this. There's lots of filters to choose from, lots of fundamental, lots of technical filters. So whatever you are looking for, a screener should be able to help. Now, depending on the broker or the charting platform that you choose, they may have a screener built into the software, but if they don't, a good free screener you can use comes from a website called FinViz. I think this is a good screener for the beginner investor or swing trader, but if you want to actively day trade, I would go with something a little bit more advanced. Now, there's all kinds of different scanning software out there that will all have different tools and features and capabilities. So depending on the style and the strategy that you choose, you may want to look into a scanner specific to your needs. All right, so I hope you all learned something. Thank you so much for watching.